Hello dear viewers and welcome to another episode of our YouTube channel, Forex. In this video, we'll delve into the details of order blocks and explore why some of them capture the market's attention while others are overlooked. To answer this question, we conducted over 100 order block analyses under various conditions to identify the specific characteristics that the market respects. We applied various rules to determine whether they increase the order block win rate and gathered some intriguing results. Our conclusion is that order blocks are effective under specific conditions when certain repetitive patterns occur in the market. In this video, we'll start by explaining the fundamental rules in a straightforward order block trading setup, and then share the results of our back testing. Furthermore, we'll discuss the necessary conditions for high probability order blocks and strategies to enhance their win rate. If you find this topic interesting, please show your support by hitting the like button and subscribing to our channel, as we regularly publish advanced trading concepts. In the concept of smart money, let me first explain some primary rules about order blocks. Basically, we consider the last candle that created the inefficiency as the order block zone. This zone is where we believe decisions are made during this candle. Sometimes, order blocks are found at the beginning of an impulsive movie, while other times they appear in the middle of the movement. These order blocks can be in the form of a candle with either the same color as the prevailing trend or the opposite color. We have three major rules for identifying a valid order block. Firstly, it must create inefficiency. Inefficiency occurs when we experience significant price movements that result in gaps between the shadows. These are examples of efficient and inefficient moves. Secondly, it must lead to a disruption in the structure or a change in character. A structural disruption or alteration in character serves as the initial indicator that the market is conveying its intention to either persist in the same direction or reverse its course. Thirdly, it must be an unmitigated occurrence. Order blocks are single, use entities. Therefore, we only seek trading opportunities when the price initially touches an order block. On the 15-minute chart of the Eurodollar, we aim to identify order blocks. Starting from the left, we pinpoint areas of clear inefficiency on the chart. We mark the candles that cause this inefficiency as our order blocks, provided that they result in a break in structure or a change in character. According to our rules, all of these are considered valid order blocks. The rules for this trading setup are simple. 1. Identify a valid order block. 2. Place your order at the beginning of the order block zone. 3. Set your stop loss at the end of the order block. 4. Target profits that are 2 times the range of your stop loss. Before we proceed, let me explain the conditions required to identify a high-quality order block. But first, please consider showing your support by smashing the like button, as this video took our team a considerable amount of time to create. Additionally, if you have any questions, feel free to ask them in the comments section, as we make an effort to respond to all inquiries. When trading order blocks, there are 4 key factors to consider, which fall into the following categories. 1. Market structure. Assess the market's overall structure to identify potential order blocks. 2. Market volatility and spread. Why to take into account the current market volatility and spread to make informed decisions. 3. Market trends. Analyze the prevailing market trends and how they relate to order block identification. 4. A recent order blocks confirmations in lower time frames. Look for confirmations of recent order blocks in lower time frames for added validation. This version maintains a clear separation between the explanation and the request for engagement while organizing the factors into distinct categories for better comprehension. Let's start by discussing market structure. I'll show you some of the most common market structure patterns that occur daily. Here, we can see a valid order block presenting a potential trading opportunity for a long position. However, if we examine the left side of the chart, we notice a gap between the candles, precisely below the first order block and another valid order block zone here. In this scenario, there is a high probability that the price will come down to fill the gap, thereby accessing the liquidity below the first order block before resuming its upward movement when it reaches the second order block. When this pattern forms with a gap in another valid order block right below the first one, we deduct 1 point from the value of the first order block for trading purposes. It's essential to keep in mind that breaking below the first order block doesn't necessarily indicate an impending reversal, as it often signifies a liquidity grab for potential future market movements. Conversely, let's examine the second pattern. In this case, we have a valid order block, and upon closer inspection to the left, we can observe that this move has effectively cleared the liquidity beneath these equal lows, potentially providing fuel for future market movement. Emerges with an order block that captures the liquidity under or above the equal lows and highs. We assign it a positive score of 1 point for trading. The third pattern is similar to the second one. Imagine we have an order block in front of the market. As the price approaches this level, it creates support, and retail traders place their stop-loss orders just below it. Therefore, there is a higher chance for the price to grab the liquidity under the equal lows and continue moving to the upside when it reaches the order block zone. Let me show you some real chart examples to illustrate this point. Here, we're looking at the EUR/USD pair in a 1-hour time frame. We can identify a valid order block that has caused inefficiency and a break in the market structure. However, when we examine the left side of the chart, we can observe multiple instances where the price was rejected at the support level. This suggests that there's a significant amount of liquidity gathered below this level. Furthermore, there are gaps present right under this zone, and another valid order block is located nearby. This combination of factors increases the likelihood of the price breaking below this liquidity zone to fill the gap and then continuing its upward movement when it encounters the second order block. Here's another example. You could have considered either of these candles as order blocks. In this case, there's a clear gap, a break in market structure, and a significant amount of liquidity gathered below these equal lows and the nearby mitigated order block. When the price breaks below this higher low, some traders might interpret it as a change of character in the market. However, by examining the left side of the chart, you can notice a clear gap and a valid order block precisely under this level. This suggests a higher probability that this move is simply a liquidity grab, and the overall market sentiment is still identified as bullish. Let's examine this bearish example in the EUR/USD 1-hour time frame. There's a clear and evident downtrend, and we can identify a distinct order block that has created a noticeable inefficiency and broken the market structure. What makes this order block particularly intriguing is that it appears to have commenced with a liquidity grab, making it a promising trading opportunity. It's essential to underscore a crucial point. Encountering a losing trade doesn't necessarily imply a specific error in your analysis. It's important to remember that no strategy is foolproof because we have had no control over the market. Market conditions can change swiftly due to unforeseen events, news releases, or shifts in sentiment, all of which can result in losses even when a trade is based on meticulous analysis. The second factor to consider when trading order blocks is market volatility and spread. When analyzing backtesting results, it becomes evident that most winning trades occur on highly volatile days and during specific trading sessions. Typically, these sessions are on the first and last day of the trading week when the market experiences higher volatility due to various factors. Conversely, during the midweek, the market often suffers from low liquidity, and this is why the majority of winning trades tend to happen on the more volatile days. Additionally, when trading pairs like the EUR/USD, it's advisable to focus on highly volatile periods of the day, such as the London and New York sessions. Trading during these sessions is preferred because during other times, you may not witness the significant price movements that are essential for order block trading strategies to make sense. In summary, considering market volatility and choosing the right trading sessions can significantly impact the success of order block trading strategies. Another crucial factor in trading order blocks is how to deal with the spread. Many times, the market reacts to order blocks within a pipe. Therefore, having a high spread on a trading pair can cause you to miss out on numerous winning trades or trigger the stop loss even when the price hasn't touched it. It's better to select pairs with lower spreads. Opt for currency pairs that tend to have lower spreads, particularly during the trading sessions when you plan to execute order block trades. Major currency pairs, such as EUR/USD, typically have tighter spreads compared to exotic or less traded pairs. Trade during low spread periods. Identify the times of the day or trading sessions when spreads are typically narrower, making it more cost-effective to execute order block trades without excessive spread-related expenses. The third factor influencing the success of order blocks is the market trend and their freshness. Order blocks tend to have a higher success rate in trending markets compared to ranging scenarios. Consequently, it's advisable to prioritize trading order blocks that align with the dominant market trend. Furthermore, focusing on recently formed order blocks is more advantageous and effective. This is because the market's direction is in a constant state of flux. Spending excessive time waiting for the price to interact with an order block often results in losing trades. This is due to the ongoing battle between supply and demand as they continually vie for control. Trading fresh order blocks generally yields higher win rates because they are more closely aligned with the current market dynamics and have a better chance of being relevant to ongoing price action. In the XAUUSD market during a clear and strong uptrend, you can frequently observe the market generating fresh order blocks, rejecting them, and then proceeding to push upward. On the contrary, let's examine another example. In this case, there is a valid order block zone. However, before the price reaches this zone, the market has formed multiple demand zones and subsequently broken them to the downside. Some traders might perceive these areas as opportunities for liquidity grabs and place their buy orders near the order block. However, it's crucial to note that supply has gained control in this scenario. Therefore, trading this order block without proper confirmation would likely not be an effective strategy. Indeed, confirmation in lower time frames is the third critical factor to consider when trading order blocks. Confirmations play a pivotal role in safeguarding traders from unnecessary losses, especially when the market decides to disregard the significance of order block. By requiring confirmation, traders add an extra layer of validation to their trade setups. Having a solid entry reason as confirmation in our trading arsenal not only enhances our confidence, but also helps in making more informed and disciplined trading decisions. It allows traders to filter out potentially less reliable setups and focus on those with stronger confirmation, thus improving the overall success rate of their trading strategy. The order block trading strategy is not limited to any specific time frame. After identifying order blocks in the higher time frame, we often zoom into lower time frames to search for confirmations and precise trading entries. For instance, when we use the 4-hour chart as our higher time frame, we look for entry reasons in the 15-minute, 5-minute, and 1-minute charts respectively. In this approach, multiple price action setups serve as confirmations for trading the order blocks. Here are some of the most common patterns we utilize in the market. In the first step of this strategy, we patiently wait for the market to validate our higher time frame order block while keeping an eye on price action to reveal its next movie. The initial signal we anticipate is a change of character. A change of character indicates that the short-term downtrend has likely concluded and the price is poised to shift upwards. Once this change of character materializes, we start considering the execution of our trade. Typically, we observe two common patterns, and based on these patterns, we determine our entry points. The first pattern occurs when the change of character move results in inefficiency and the formation of a valid order block. In this case, we place our order a spread size above the order block and position our stop loss a few pips below the lowest point of the zone. To manage our trades and aim for favorable risk, reward ratios with reduced stress, we employ a straightforward technique for taking profit. If the price moves in our favor and begins to rise, we adjust our stop loss beneath the evolving market structure each time the market establishes a new higher low. This method enables us to allow our trades to run profitably until we reach a higher time frame supply zone, at which point we close the trade. The second pattern comes into play when we observe a change of character in the market, but there are no inefficiencies or gaps between the candles. In this scenario, we initiate our trade using retracement levels following these steps. 1. Apply the retracement tool from the beginning of the change of character, move to its end. 2. Place a buy order at the midpoint between the 61.80 and 78.6 retracement levels. 3. Set our stop loss a few pips below the swing low while targeting the next structural level in front of the current price. It's crucial to note that these trading setups are versatile and not confined to any specific time frame or currency pair. However, conducting thorough backtesting is essential to determine which pairs are most suitable for these strategies. I urge all of our viewers to make a visit to Hanko Trade Broker and open a genuine account to truly feel the transformation. What's more, the broker is offering an incredible 1100% bonus upon registration, and I've conveniently included the registration link in the description for you. Don't miss out on subscribing to our channel and showing your appreciation by liking our videos. Your support serves as our driving force to keep delivering more. I kindly implore you to share this video across your social networks so that everyone can reap the benefits of this invaluable free tutorial. Until our next lesson, may you be blessed.